Ladies and gentlemen, good day and welcome to Sterling Tool Limited Q3 and 9 months FY'24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of the future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pankaj Gupta, Group CFO, Sterling Tools Limited. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone. On behalf of STL Group, I extend a very warm welcome to our Quarter 3 and 9 months FY'24 earnings call. I'm joined on this call by Mr. Atul Agarwal, our whole-time director, Mr. Jaideep Wadhwa, director, and SGA, our investor relation advisor. We have uploaded our results presentation on the exchanges, and I hope you had a chance to go through them. I will now request Mr. Atul Agarwal for his opening remarks. Thank you.
Good afternoon, everybody. Welcome to the call. I'm going to dive down directly to more company results, performances. You guys get a lot of industry overview. You're probably more aware than I am what's happening in the industry. So let me just dive down broadly as to where we were in the last 3 months and the last 9 months for this financial year. During the quarter, Q3 for FY'24, our standalone numbers of revenue have declined by 6%. If you look at our fasteners vertical from a segment-wise perspective, the business operations catered to two-wheeler and PV industry have performed very well, whereas our sales to commercial vehicles and farm equipment sector witnessed headwinds, causing us this stress in our revenue growth. We also have some issues in our customer portfolio. We'll get into it in more detail in the Q&A. Having said that, we expect to mitigate these concerns and risks with a stronger performance in Q4 and the next financial year. Our EV business under SGM has contributed to 33% of our overall revenues versus 21% in FY'23. So that vertical is showing tremendous growth, and there's a lot of momentum in that business. We have also completed the localization of the MCU for L3 category, which indicates our commitment towards working on newer products in the EV ecosystem. SGM gives us a great trust on technology, and in line with our vision, the company has embarked on a SAP implementation as well. We're excited to inform that SGM has booked its first export order, a testament to our effort as a team and product quality. Finally, a couple of large other strategic developments. We are pleased to announce to strengthen the Sterling Tools leadership team at the board level with induction of Ms. Rashmi Urduvarshe and Anish Agarwal. The profiles have already been uploaded on the exchange and they're part of the deck as well. They will bring in unparalleled experience to drive innovation and success. Their extensive expertise is poised to fortify the company's strategic objectives, ensuring continued success in this sector. Their visionary leadership seamlessly aligns with our commitment to innovation, reinforcing our readiness for sustained growth in the automotive ecosystem. I'm going to hand you back to Pankaj, who will give you more insights on our financial numbers.
Thank you, sir. So, I'll give the financial highlights for Quarter 3 and 9 months FY'24. Total income on a standalone stood at 142.7 crores, and 9 months we achieved 446.7 crores. EBITDA margin for the quarter was 21.3 crores, aggregating to 65 crores in 9 months. EBITDA margin stood at 14.9, and we had a profit after tax of 36.2 crores in 9 months. On consolidated level, the total income increased to 234 crores in Quarter 3 as compared to 208 crores in Quarter 3 last year. Our blended EBITDA margin stood at 12% in Quarter 3, and 9 months EBITDA margin stood at 12.3%. Profit after tax aggregating to 39.1 crores in 9 months. Thank you, everyone, and we can begin now the question and answer session.
Thank you very much. We will now begin the question and answer session. Participants present on the audio bridge who wishes to ask question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Deepan Sankara from Trustline PMS. Please go ahead.
Good afternoon, everyone, and thanks a lot for the opportunity. So firstly, from my side, so what are the drivers for such strong performance of EV business in the current quarter? So if I put together Ola and Ampere volumes for the current quarter, the growth is coming only around 25%. So the higher growth in volumes, how is that possible? So is it due to new customer additions or higher volume from LCV business?
Good afternoon. I have to say that currently, while our confirmed orders we've now got 20 customers that we have confirmed orders from. I don't believe that the LCV or HCV businesses today make a significant impact on our revenue numbers because these productions are the customer programs are still to really get traction in the market. Our performance is based on our existing customers and their growth. It's not easy, and I think we've discussed this in the past also, that it's not easy to match exactly the numbers even on a quarter basis, because there is obviously some stock building or stock depletion that takes place with various customers. So we continue to do well with the customers that we have. We continue to be 100% suppliers to them, so sole suppliers to them. But the LCV and HCV businesses have yet to really get traction because our customers have not launched these products in the market fully as yet.
Okay, got it. So that means to say even the other two customers, Tork and ACG, also could have performed well in terms of volumes.
So all across, I mean, we've got a number of customers. So they've, all these customers have done reasonably well. We have done slightly better than if you look at the overall market for high-speed scooters, which is our biggest play. We have outgrown the market, but that's really to do with how our customers in this market have done vis-a-vis their competitors.
Okay. And also, could you please throw some light on our strategies on increasing revenue contribution from non-Ola type of customers and also non-scooters business in the areas of LCV, PV, and MHCV?
Yeah. So. Yeah, so LCVs is something which we are very excited about because we've got contracts from most of the LCV manufacturers in the country. There is our revenue numbers don't give the same or don't reflect the success we've had because there are huge delays in homologation of these vehicles, and therefore they are not. Our customers are still buying these in the tens rather than in the hundreds or thousands. But I think we are the best placed in the LCV segment, and our market share in this segment will be again in high double digits as we are with the high-speed two-wheelers. So that's one big focus area for us. And also in the HCV space, we are making inroads with some of the customers on products that are going into heavy commercial vehicles. Volumes are low, but we have the early mover advantage, and we'll continue to strengthen our position there. Beyond that, as I mentioned in the past, we look at we are looking at adding additional products, which will give us a higher share of wallet from these different customers.
Okay. Great to know that, sir. And lastly, are we discussing with any of these top players as a second supplier for EV two-wheelers, scooters itself?
So we are in discussion, and I guess when you say top players, you're talking about the incumbents. Yes, we are in touch with. Yeah, so we are talking. We are in discussions with nearly all of them. Each of these companies has a very healthy pipeline of innovation and new product launches, and we are in discussions with them for some of these new products. So I'm just it's a very subtle difference, but I'm just clarifying. It's not that we are looking to be we are in negotiations to be a second source for an existing model. We are in negotiations to be supplying products for new models that they are launching, and as you know, that they've got a number of models in the pipeline.
Okay. Thanks a lot, Jayant Bhatt.
Thank you, sir.
Thank you, sir. We have our next question from the line of Abhishek from Dolat Capital. Please go ahead.
Thanks for the opportunity, sir, and congrats for a strong set of numbers in EVs business. This year, in MCU business, most probably will cross the 3 billion revenue. So just wanted to understand what is the guidance for the next year for FY'25 for MCU business.
Okay, I always get I don't know how to answer such questions because it's very difficult for us to give forward-looking statements. I think the only guidance I can give is that the EV industry is set to grow in healthy two-digit numbers or in the healthy two-digit margins, even despite all the issues with FAME 2 and so on and so forth. We're still, I'm very confident that the industry will grow in strong double-digit numbers, and our growth should be in line with industry growth, thereabouts.
And on the margin side, the current margin for the MCU business has gone up to the 7.5%, which is quite decent. So going ahead, if we want to achieve the 10% kind of the margin, then what kind of the peak revenue you need to achieve?
So I'm glad you said that because I'm going to tape that and give that to my board because they don't think it's good margin. But so we as we've stated in the past also that we believe that the long-term margin potential for this business is low double digits, and that's what we want to move towards through expansion of our product through both margin improvement actions on existing products as well as getting greater volume leverage and in the future also bringing in-house additional operations. So I can't say that it will be next year, but we do hope to be able to be in the low double digits in the medium term.
And a few questions from the standalone business. In the 9-month FY'24, how was the segment-wide contribution in the revenue in passenger vehicles, CVs, two-wheeler, and tractor?
Concall, you want to take that?
Yeah. So just give me a second, Abhishek.
Okay.
Abhishek, the mix in this 9 months have been, we had 87% sales coming from OEM and 11% coming from the retail. And segment-wise, we have passenger vehicles contributing 28%, two-wheelers 24%, commercial vehicles 22%, farm equipment 13%, and retail 11%, as I said.
So that is for the standalone business, right, sir?
That's right.
Okay. And in a fastener business, basically, as you mentioned that quarter four would be strong because of the increase in the production of the OEMs. But you have also mentioned that there will be strong growth in FY'25. So what are the key growth drivers in FY'25 revenue growth, sir?
So, if we analyze our first 9 months of this financial year, and you look at the industry has grown in passenger vehicles by about 5 or 6%. There's growth in two-wheeler segment. I think there's also marginal growth similar in commercial vehicles. Farm equipment is one sector which is negative, substantially double-digit negative for various reasons. So, and if you see our customer portfolio in two-wheelers, we work with market leaders, Honda Motors and scooters, and we've added Hero MotoCorp a couple of years ago. And in passenger vehicles, we work with Maruti Suzuki primarily, and with Mahindra Automotive Division. So in these two segments, I think if you look at the names of the customers we have mentioned, these customers have grown marginally themselves, HMSI and Maruti. But a lot of the growth in these segments have come in, say, in passenger vehicle, Hyundai, Kia, and Tata PCB has grown dramatically. Unfortunately, they do not they're not part of our customer portfolio, which is what we're trying to address. Even in two-wheelers, we are working with HMSI. There's been a marginal growth in HMSI. Bulk of the growth in two-wheeler segment has come with TVS and Bajaj Auto in these areas. So it's like I said in my opening statement, the issues on our customer portfolio, which we are trying to address in these customers by being more aggressive with customers like Hero MotoCorp, and we've already got LOIs from Hyundai as a business, but the revenues meaningful or material revenues will come over the next couple of years. So you won't find a dramatic shift happening in FY'25 on this thing. But last quarter, since you mentioned about last quarter, we are hopeful that last quarter will be a strong quarter, probably one of the highest quarters we get in this financial year. There will be substantial revenue growth we expect in Q4 over the other quarters we've had. And I don't want to give a strong guidance. All I can say is that in a fastener business, we are a strong supplier to all OEMs in India, number two in revenue terms compared to our competition. So there are opportunities, but unfortunately, the opportunities are not as large as our EV business. Our EV business is growing dramatically. The potential for growth there is much more dramatic going forward as well. So when we compare the fastener vertical with other product lines on the EV side, it does not look very attractive, but still there will be some growth coming in next year.
Okay, sir. And my last question on the operating margin side on standalone business, it is still quite low at 14% versus historical high of 18 to 20%, despite the benign commodity prices. In this case, what are the plans for the expand margin to the 16-17% in the standalone side?
So I think firstly, we have addressed this issue. One particular factor in this issue on numerator-denominator effect, where the steel prices went up dramatically. They may be soft, but they're not corrected. They were corrected marginally, not to really impact that equation. So I think that impact of that numerator-denominator is closer to 2.5%. Now, having said that, this quarter we are showing an operating margin of 14.9% despite a muted revenue number for the quarter. It's on function of softer steel and other cost-saving initiatives on the shop floor. The main concern is not from a cost perspective. Our main concern is from a revenue growth perspective. So we are addressing that. It's a combination of addressing the revenue growth concern and also keeping an eye on our cost centers as well. So, we expect Q4 to be a stronger margin structure because of revenue growth coming in. But for a full year, it'll be hovering, I think, very similar to what we have shown right now.
Thank you, sir. This is quite helpful.
Thank you, sir. A reminder to all participants, you may press star and one to ask questions. We have our next question from the line of Himanshu Upadhyay from Bajal Rock PMS. Please go ahead.
Yeah, hi. Good afternoon. See, my question is on the standalone business and looking at a longer term perspective. So if I look at 2018, okay, our revenue has grown quite significantly, okay. But so from 450 crores, we'll be doing nearly 600 crores, and what we did last year also, okay. But if I look at my absolute operating profits, okay, which was 90 crore, has remained flattish, okay. So despite 35% growth, and what we have also stated that we have added many new customers, okay, in last few years, okay. So how much would the volume be higher than 2018, and where are we stuck up? Means I am not talking about percentage. I understand because of steel prices and all those things vary. But I am more interested in the absolute operating profit, which we did of 91 crore, where we are still there. Yeah.
So, good question. Let me try and give you try and give you a big picture perspective. I don't want to dive around into too many numbers here, but it'll give you a sense why the numbers are the way they are. Our Bangalore facility went online a couple of years ago, and the investment in that facility is close to 200 crores. It's about 180 odd crores right now, but I think before we are fully optimized it current, we'll probably be at a 200 crore level. So a lot of capex went into it, which also meant from a pure operating cost perspective, OPEX perspective, there's obviously a certain amount of cost we carry in manpower and operations vis-a-vis FY'18-19. That's one factor which is impacting the cost structures. Second impact would be FY'18-19. The steel prices were not a factor at all. Steel was soft that year. This economy was strong. Steel was soft. Customers were very aggressive as well. We were able to get good prices, hold our prices, etc., etc. I think both the reasons compensated. Now, if you look at the overall industry numbers vis-a-vis 18-19, and you do segment-wide analysis, the only segment which has really grown over 18-19 is the passenger vehicles. Two-wheeler segment is still negative of financial year 18-19. I think you're looking at about 18 odd million this year. We are at a peak level of 22 million in that particular financial year. Commercial vehicles also saw a peak in FY'18-19, and I think that commercial vehicle number is still coming close to that. So the growth has only come in the passenger vehicle segment vis-a-vis 18-19. On our Sterling specific level, I mentioned two particular reasons. One, the Bangalore facility went up, which has added to our cost structures, which will get optimized and rationalized. We believe it takes us 5 years to optimize and rationalize the full facility and bring all costs in alignment with our revenue numbers, etc. So we are on track with that. And secondly, I said steel was also a little softer in that particular year. I hope I'm able to address your question.
Yeah. Okay. So the economies of scale has to yet to play out in the Bangalore facility. That would be the.
That's correct.
My understanding.
That's correct.
That has to play out. Okay. And the second question was in our May 2022 call. Okay, we said that there is an opportunity of AC drives. Okay, which GTEC was AC drives. Hello.
Yeah, okay.
And we said that GTEC was having a relationship in India and was supplying a lot. That relationship is no longer there. And over a longer period of time, it can be an opportunity for us. And in last calls, we have also stated that we want to grow more into electric vehicles and newer product introductions. What is the opportunity in that AC drives business for auto? And did we proceed on that space, or just some of your thoughts? And if no, then why not? Is the focus now?
So the AC drives is a purely industrial product. I mean, an AC drive could be used in solar plants, could be used in in any manufacturing operation where they want to drive energy efficiency. Now, obviously there are while the technology is very similar between an AC drive and a motor control unit. In fact, the motor control units have been derived from the AC drives per se. But we feel that there's so much opportunity in the EV space that we are really focusing more on the EV space right now, and not as much on the industrial aspect of it. While there is probably an opportunity there, it's not something that we're looking at in the short term. For us, the short term, we have to have a laser focus on the automotive industry and the and even within that, the electrification of the automotive industry.
And one last thing, can you give an idea of Sterling Faber India? Means why could not that scale up that when we had that JV agreement, not JV but understanding and everything? And what is the future there?
Okay, so I'll just take that for ease, just for convenience. I'll address that, Atul, if that's okay with you. So that the business of supply chain management has a couple of complexities. One, of course, is that a lot of what you do is buy out from other suppliers. A lot of these relationships are global relationships or long-term relationships, and I think that we were not able over that period to manage this as effectively. I mean, this is not a large market in India, the market of the supply chain management, and because the industrial, the scale of the industrial companies that typically are customers for this is not what it is in more in other geographies. So maybe the timing of our venture into this, our competitive positioning was not what it should have been. Atul, anything you like to add further? Talking about February and the
why we liquidated.
Why we were not successful.
So that business, I think I don't remember the exact timeline. Broadly, I think we got into a JV agreement with them in 2010, give or take a year or two. I'm not really that it's on the top of my head. The basic premise of that business was like the West, wherein we do C-class products. The variety of SKUs runs into thousands of components. Auto OEMs or non-auto OEMs companies, let's say when I say non-auto OEMs, would be companies like Siemens, Alcatel, Atlas Copco, from a multinational perspective, or companies in Indian perspective like L&T, etc. When they buy C-class parts, they don't want to work with manufacturers. They want to work with supply chain companies, and who basically do warehousing, stock management, inventory management, Kanban system, basically take over their in-house purchasing teams, where they don't have to have in-house purchasing teams for those products. They don't have to hold inventory in-house, and that entire operations are outsourced to a supply chain company, which is what we were trying to be. From the customer perspective, it brings down their total cost of ownership, TCO as they call it. Unfortunately, this business model has not succeeded in India. The customers want to work with manufacturers directly. They do not. Our current business practices do not favor addressing TCO issues. It's a very complex calculation. They're not able to understand that. Culturally, they're happy working with manufacturers and not with consolidators or supply chain companies, which is what we were trying to do in the JV with February. So we tried that for almost 10 years, I think, and eventually we sat with a partner and said, it's not working out. No point spending more man hours and capital behind it. So we decided to liquidate that operation and shut that operation.
Okay. Thank you from my side. For further queries, I'll join back the queue.
Thank you, sir. A reminder to all participants, you may press star and one to ask questions. We have our next question from the line of Hardik Doshi from White Whale Partners. Please go ahead.
Hi, can you hear me?
Oh, yes, sir. We can hear you. Please go ahead.
Okay. Yeah, thanks. Sorry, I joined the call slightly late. Just two questions. One is, on the standalone part, for the quarter and also for the full year, the trends have been quite muted. Can you just talk a bit about that? And the second question is, there's a Ken article recently talking about how Ola Electric, as they're going public, are looking to in-house more and more of their parts. There was also some mention of motors. There wasn't any mention of MCUs. But any commentary and the risk that we have of them moving some of it in-house?
So, let me take the first part of the question. I think Jaideep will get into that MCU business. On our standalone, our fastener business, we've been around. Like I said, we are a number 2 fastener maker in India, working with almost all the OEMs. We've been around for 40 plus years now. We will still grow this year, maybe albeit marginally, and our growth going forward will also be there. But like I said, it may not be as dramatic as our EV businesses. But we have some weaknesses in our customer portfolio, like I mentioned earlier, which we're trying to address, and which is also going to play out over short to medium term. So we are from a margin structure perspective, we are quite comfortable. There are stresses on it, but that's the nature of any business. That's the nature of the Autocom Tier 1 business we are in. We are comfortable in that space. We know we are on top of things. We'll be able to handle that. So no, from a big picture perspective, our standalone business, there are stresses, like I said, in our customer portfolio, which we are addressing. But from a long-term growth perspective, we're also comfortable knowing the size of the market, knowing where we are currently, and how we can grow in that business. But yes, that's the nature of the business we are in today. I'm going to hand over to Jaideep to talk more about the MCU business.
Just a clarification on that. So when you're saying that stretches in the customer, is it our orders with the customer? Because overall, two-wheeler volumes and even passenger, pretty much across the board, volumes have been quite good, right?
Yeah, so, I don't think that there's stress in our customers at all. I'm just saying we are working with market leaders in each segment. Let's say Maruti Suzuki. Maruti is already at a 42% market share in India in the passenger vehicle segment. Bulk of the growth, if you see in the last 2-3 years, has come from Hyundai, Kia, and Tata PCB and Mahindra ADD. So it's a customer mix we need to improve, but there's no stress for the existing customers. We are growing faster than they are growing. This means we are adding more products with them. Like, Maruti, I think the Maruti growth is probably more like 4% this year. Unlike Tata PCBU or Mahindra ADD is up 27%. Tata PCBU is doing very well. We don't have them in our customer portfolio. So they are customer portfolio issues. They are not customer-specific issues in our case.
Understood. So the models that you probably supply to are the ones under pressure.
No, I'm not even saying the model. I'm saying the customer. Like I mentioned, the passenger vehicle segment. We are growing with Maruti. Maruti is growing 4%. We are up 7, 8, 9% with them this year. But the issue is not Maruti Suzuki as a customer with us. If we want to, the passenger vehicle segment is growing on the back of growth of Hyundai, Kia, Tata passenger vehicle segment, and Mahindra ADD. Maruti is growing slower than their own passenger vehicle industry. So, in other words, their market share is shrinking, but they still lead the market. They still have the market share. So it's not a model issue. It's we need to add more customers in that passenger vehicle segment. That's an issue.
Okay, got it.
Okay. To address your question regarding Ola, going back, I'm going to say 6-8 months ago, Ola released a video of a motor and a controller that they had developed. But till today, 100% of the vehicles use our controllers. So, I think what we believe we have to do is we have to give our customers a better product and a better price, so that in the make-buy decision, they always look at buying from us, or not always, but they look at buying from us rather than trying to make it themselves. There is a chance that for some models, Ola could decide to go in-house, and that's something that our only way of countering that is to continue to give, like I said, better product, better price, so that it's in their interest to source from us. The industry is still very young. I think we've had this discussion several times in the past. There's a number of customers believe that they should make products in-house. If you follow what's happened with the internal combustion engine, everything started in-house and then everything moved out, initially into companies like Delphi and Visteon and Magneti Marelli, and then those companies were finally spun out. So one believes that there will be, at any given time, there will be some companies that will manufacture in-house, and there will be some companies that prefer to work with partners. Companies that are very agile and have plans of a number of product launches will, I believe, prefer to work with external partners, because that they can then focus on developing vehicles and not have to worry about making components. But it's something we'll have to wait and watch. Our strategy, like I said, is focus on making sure that the customer has a good reason to stay with us, and to look at diversifying the customer portfolio to the greatest extent possible, so that we have more than one big customer to count on.
Okay, got it. Thanks.
Thank you, sir. A reminder to all participants, you may press star and 1 to ask questions. We have our next question from the line of Kevin Shah from FinAvenue Growth Funds. Please go ahead.
Hi, good afternoon. Thank you for the opportunity. In your recent quarterly PPT that you all released, in one of the slides you mentioned that the company is working to launch additional power electronics and electrical products to capture higher EV wallet share. So could you please give some color or throw some light on which products we are building? Thank you.
So there, as you're very familiar, in an EV there are very few components that are there. You essentially got a charger, a battery pack, a motor control unit, a motor, and a DC-DC. So that's pretty much the entire architecture of an EV. On top of that, of course, you have a vehicle control unit, you have cooling, and you have the connectors and the wiring harnesses, etc. Our ambition is to play in all of the electronics, so we are evaluating opportunities in the charging space as well as in the DC-DC space, both of which use very similar technologies to what we use in a motor control unit. But I cannot confirm that we will be what products exactly we'll be doing, because that depends on the partnerships that we finalize and the business plans that get finalized thereafter.
Okay. Thank you for that answer. And just one question on our proprietary model of the MCU that we are building for the two-wheeler space. In the previous call, you had mentioned that it will be available for commercialization by the end of FY'25. So are we still on track with our internal process for that?
Yes.
Okay, sir. Thank you so much, and all the best for the fourth quarter. Thank you.
Thank you so much.
Thank you, sir. A reminder to all participants, you may press star and 1 to ask questions. We have our next question from the line of Aditi Sawant from AMD Capital. Please go ahead.
Yeah, hi. Thank you so much for the opportunity. Can you throw some light on the details of the export order received in the SGEM entity?
Okay. So first of all, let me explain that this is a contract manufacturing opportunity where we are manufacturing for someone else. Due to confidentiality reasons, I cannot provide details of who the customer is, but it is in the EV space. And it's not necessarily in. I also, the only other hint I can give you that it's not necessarily in motor control unit, but it's an allied product. The other detail I can give you is that the revenue potential is about 1.5 to 2 crores in the short term. So it's a small business to start with, but we are excited about it because it opens a door that we believe leads us to good opportunities in the future.
Okay. And what is the amount of the order and timelines to meet the order, or which country we are going to be shipping this?
So, as I mentioned, the order is for about 1.5 to 2 crores to be shipped in the before the first quarter of FY'25. It is to a country in Europe.
Okay, got it. And sir, can you elaborate on the localization of MCU for LCV category? I mean, how was it structured earlier as compared to now?
So, this is just, I guess, sometimes when we write these out, we're getting into a little bit of a technical detail. So, the important, when we start a product, typically we import complete units from China and supply them to customers, and they test them out, etc. Once the product is proven, then they give us a formal order, and basis that formal order, we make a business plan and make the investments on the assembly lines and testing and so on and so forth. And then once we make the product in India, then the customer and we have to retest it to make sure that what the product that's made in India performs to exactly the same specifications as the product that we had imported in the past. So while we had got these businesses, and the complexity on all this is that this is all to do with the FAME subsidy, and the government, because of the misuse of the subsidy that happened with some OEMs in recent times, the government has a tremendous scrutiny on what is done, and this was really to say that we have passed the government's audits, etc., to say that this is now a localized product, and our customers who are using this for their production can get the subsidies. So, and that's what I was talking about earlier about the traction in the light commercial vehicle space, that the customers can now get the subsidy that they're looking for, but some of them have not got approval for their vehicles from ARAI or ICAT, and until this is done, they cannot start selling them, and they're limited to testing them and using them in very controlled environments, and therefore we don't get the volumes that we had projected until this happens. So this is really an acknowledgement of the fact that we've crossed that hurdle for this motor control unit for the light commercial vehicles.
Okay, got it, sir. Thank you so much for the detailed explanation. Thank you. That's it from me, sir.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. We have our next question from the line of Anuj Sharma from M3 Investments. Please go ahead.
Yeah, thank you. 2 questions, both on fasteners. One is, as per my understanding, even today, 15 to 20% of the fastener market is imported. Just outlook there, is it something which we can replicate in-house, or that's technical capabilities we don't have, or it's just the stickiness of external customers or international suppliers? And the second is, what is the outlook of smaller players? Some of the smaller players in the fastener industries, like Lakshmi Precision, and were out of the industry. How is the competitive scenario now with other players? Thank you.
So, on the first part, government has come out with a quality control order, QCO, and they are forcing the OEMs to buy from BIS certified manufacturers for fasteners. Sterling Tools has been able to certify all its facility for BIS under the QCO. There's a large, the import of fasteners is happening from companies like Suzuki, Maruti Suzuki, Hyundai, Volkswagen, or Toyota, etc. Now, these companies are being forced to localize these components to fastener makers like us. But I think this is a phased out program over 3 years, which will happen. One needs to have certain technical capabilities. Fortunately for us at Sterling, we have them, and hopefully we'll be able to crystallize some business under this program of BIS and QCO. But the opportunities will be primarily with Maruti Suzuki, Hyundai, and Toyota. Tata, Mahindra are pretty much localized already, so they don't have any import component for fasteners. So yes, there'll be opportunities coming our way for that. To the second part, on the competitive landscape, I think Lakshmi Precision probably shut down 5-6 years ago, and Sundaram is leading in terms of market share in the OEM side of the business. We are number 2 in that segment. There are other players who have grown as well in the last few years. Some are out of Nasik and Punjab region. They all have seen growth, but we believe in the segment we are in the kind of products we do. Sundaram and Sterling still are competing against each other on these product categories. So in the short term, we don't see much threat in that.
All right, that's very helpful. Thank you so much.
Thank you.
Thank you, sir. We have our next question from the line of Amit Kumar from Determined Investments. Please go ahead.
Yeah, thank you so much for the opportunity, sir. On the MCU business, just one sort of point, point on the EV industry. So we understand that, the existing, subsidy regime is only up to 31st of March 24. And just wanted any clarity. I mean, are we sort of seeing any sort of extension to that, or, any sort of way forward on that side, basically?
So, we were hoping that we would hear some announcements from the finance minister, but that didn't happen. So I think we should assume that the subsidy will be removed come 31st March. But I believe that the industry will continue without more than a big hiccup. The big reduction in subsidy already took place last May, and the amount of subsidy left is now not that significant. The industry has already adapted, and I'm speaking specifically about the two-wheeler industry. The industry has already adapted. They're bringing out new models which are more economical, essentially by looking at reducing the size of the battery and making it more viable than some of the products that were there at the beginning of last year. And I think that the industry has, with the quality of products that are now available, the rationale for buying EVs is there. I mean, people believe that there is there is a benefit to buying EVs. There is the EV experience is such that the customers are willing to pay a little bit of a premium for that. So I think that despite the reduction or elimination of the duties come 31st March, you will continue to see growth in the two-wheeler segment.
So just one sort of point on this, any sort of sense you have, of industry growth? I understand your business would be very sort of OEM specific, so how the OEMs, deliver will be a function of that. But, what sort of industry growth in terms of volumes should we expect, let's say this year or, at least in the near term over a 2-3 year period? What are the assumptions that you are working on, that would be helpful?
So if you look at, and there are hundreds of reports out there that forecast the industry growth over a period of time. They talk about penetration of EVs across various categories, going from obviously the lowest penetration will be in passenger vehicles. The highest penetration will be in three-wheelers and LCVs, and two-wheelers, especially two-wheeler scooters, will also is expected to see about 30% penetration. Now, I believe all of these forecasts or projections account for the fact that the subsidy is going to go away, and if you look at those kind of numbers, you're looking at very healthy growth rates. I would say that if I had to do an average of most of the reports I've read, I would say the EV industry is going to grow. I would say that they would indicate that the EV industry is going to grow by about 40% a year over the next 5 years. Now, is that actually going to be 40%, or is it going to be 20-30%? But like I said earlier, when talking about our growth, I believe that whatever the case may be, it's going to be in the high double digits for sure.
Okay, this is helpful. Thank you so much.
Thank you, sir. A reminder to all participants, you may press star and 1 to ask questions. A reminder to all participants, you may press star and 1 to ask questions. As there are no further questions, I would now like to hand the conference over to Mr. Atul Agarwal for closing comments.
Thank you, everybody, for participating today. I think I hope this was able to give you more insight into our businesses and the way forward. We'll be interacting with you again very soon, some of you individually, and probably our annual accounts call sometime in April this year. Thank you once again.
On behalf of Sterling Tools Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you. Okay.